When you're evaluating potential properties for your acquisition, what are the key things that you're looking for? Are you and where do you start? I mean, there's so many different dynamics, right? So you can start with the property or you can start with the market. So can you walk us through the whole uh, quote unquote acquisition strategy here?
Yeah, so we use what I call a top down, bottom up approach, which the top down side of the approach is that we look for markets that we think have a long runway and a positive story. And so one of the ways that I like to articulate that is that we invest in places where people are moving to, and we avoid investing in places where people are moving from, because uh, income real estate is valued by the income, and the income is directly tied to the job growth, population growth, and income growth in that local area. So if we can invest in places where people are moving to, we find that we have population growth. And generally, that also means that there's job growth. And usually, that also means that there's income growth. So that we first look for those markets where we can find that job growth, income growth, and population growth. And then within those markets, that's kind of our top down approach. We'll drill down a little bit more to look for areas that are lower in crime, maybe a little bit higher in median incomes and that sort of stuff. And then we begin our bottom up approach where we're looking for assets. Now we're looking at the real estate and kind of coming up from the bottom. It's like, okay, what's the condition of the property? What year was it built? What kind of rents is it getting? How do those rents compare to other similar properties and the rents that they're getting? What improvements might we need to make, and that sort of stuff. So our buy box right now is tends to be more in kind of like growth markets, southern half of the U.S. where people are moving to. Investing in assets that are newer. We like Class A assets built after 2000, multifamily, larger than 100 units, 200 and up is even better. That's kind of our like main criteria, and then beyond that, then it's just drilling down into kind of more of the details.
Sure. So this is how you're looking at the property. Now let's talk about the financial metrics of the same thing, right? So you find a property that kind of fits that general criteria, that buy box. It's into the location, the crime rate, and it's fits the general buy box criteria. What are the financial metrics now that you're looking at from your analysis standpoint to say, yes, this meets Brian Burke's, test, and this is what I'm going to acquire?
Well, one of the first tests and most important tests today, and this is a little bit of a moving target because in different market conditions, the way you look at the financial measurements is going to differ. But right now, when you're in this market where there's uncertainty as to the future, you don't know exactly where interest rates are headed, you don't know exactly what rent growth is doing because we're in this transitionary phase. To me, what's really important is current cash flow, because that's money in the bank right now. And so, as I mentioned before, we fund our acquisitions by raising money from investors that invest into funds where we acquire these properties. Now, to get an investor to invest, you have to present them with an opportunity that's better than other opportunities that are immediately available to them. And so I think one of the best examples of that is a money market account. Right now, you can open up a savings account and put your money in a money market fund and earn 4.5% almost risk free with complete liquidity rights. And that's very difficult to compete with if you're looking at buying, say, a multifamily value add property where year one cash flow, if you're being honest with yourself, is 1%. And then maybe by year three, it's 4%. And then by year five, it's 5 or 6 or 7%. That's been the traditional value add model that a lot of acquisition criteria has been molded around for the last decade. But now with 4.5% money market accounts, who's going to take their money out of a 4.5% money market account with full liquidity and safety and invest it in a risky multifamily deal for a 1% cash on cash return and the hope that maybe the value will go up later? So right now in today's market, I'd have to see to get me off the fence is immediate cash on cash returns that beat a money market account. So maybe a 5% cash on cash return day one out of the gate on Class A property. That's kind of one of the lower risk buckets of commercial real estate. And then the rest of this is kind of the belief that the market's going to significantly change over the next 5 years. And by the way, I'd have to see that 5% cash on cash return with a fixed rate loan where I can lock in our interest rates. We have, at least some cost control that's in there, low leverage, probably somewhere in the 50 to 65% loan to value ratio leverage point. Not over levering, so that it's a high hurdle to cross to get 5% at a 55 or 65% LTV on a fixed rate 7% loan when cap rates are in the fives. So that's one of the main reasons we haven't bought anything in 3 years, is it's very difficult to find properties that will meet that test. Now, I shouldn't say that. Every property can meet that test at the right price. It's very difficult to find sellers who will part with them for a price that will produce that result. And so that's really what we're waiting for. We need to wait for sellers to be in a position of urgency where they need to sell that property, and that's the best price they're going to get.
So in your fund, the investors that invested, right now you have not acquired anything in for the last 3 years. Instead, you were doing the opposite, where you were kind of selling it, right? Or you kind of timed that. So how are the investors kind of making their returns, or how are you producing returns for them? Are you just producing the returns based on the underlying assets, whatever is left over? Because you started with 4,000, you sold over 3,000. What's left is about 1,000, right? Or you had different funds for different properties, and you're like, okay, fund A is closed, fund B is closed, fund C is closed, but D and E is still kind of pending. So what's your model?
Yeah, it's more like the second version there, where we've had a series of funds that acquire properties during different periods of time. So we don't have an open-end evergreen fund where we buy and then, we raise more money and buy some more and then raise more money and buy some more. These are closed-end funds where we might say like, okay, we're going to raise $50 million. And once that money is spent, that fund is closed. Then we raise another fund. And it's helpful to segregate these things out by vintage that way to a certain degree, because what we don't want to have to worry about is, let's say we buy a property 5 years ago and then it goes up in value, and now we have new investors coming in and they own a piece of this asset that we've owned for 5 years. The other investors have been there the whole time, and now a new person comes in and gets a piece of that without having been there the whole time the other investors were in there. So there are different ways to address that problem, by marking shares to market and other things. But instead, what we chose to do was to just separate those vintages out into separate funds. And so when we started selling, we're on our 7th fund now, or maybe 8th fund. And we were selling kind of in the earlier stuff that we'd had. We started selling those. We got into selling our Fund 6 product, and we sold one property out of that fund and then had another one in escrow when the light switch got flipped. And so that deal did not close. So I can almost tell you to the day when the market changed, because it was right in the middle of that escrow when that deal didn't close. So we got kind of quote unquote stuck with that one. So the earlier funds that had exits, those funds did remarkably well, as they would in any time when you have a market that's increasing in value. And the 1,000 units that we have left, while they're holding their own, we're in what I call more of a market survival mode, where it's like, look, whatever returns we thought we were going to get when we made this investment, the market is not going to give that to us. Now what we're going to do is we're going to hold on and we're going to sell in a better market. Now, we don't know what that's going to look like. That better market may be so good that we get the same returns or similar returns to what we had originally forecasted, regardless of the fact that we felt a lot of pain along the way. Or it could be a scenario where the market just comes back and we're able to at least get out of them clean, maybe make a few bucks for our trouble and move on. And that's kind of real estate investing in general. Whenever you're investing in a low market and selling in a high market, you're going to do really, really well. And whenever you're investing in a market that turns on you during your hold time, you're not going to do as well. No matter how good you are, smart you are, or how much you thought you timed it, the market is really the one in control.